Welcome to my presentation about my bachelor thesis on the topic of unconventional monetary policy. Since the global financial crisis of 2008, many central banks around the world have resorted to unconventional monetary policy, which consists of measures aimed to adjust the dysfunctional financial market and measures aimed to improve the monetary transmission mechanism. So, after the securities market program and the outright monetary transactions, the European Central Bank started with quantitative easing, negative interest rates, and forward guidance from 2015 onwards. As of now, the ECB has stopped with these measures, which leaves us with the question, what is next? There are two challenges that policymakers face today. First of all, how can we normalize the situation without compromising stability? This means returning to an environment without excess liquidity, positive policy rates, an upward sloping yield curve, and a smaller sized balance sheet. Secondly, it is necessary to address how future monetary policy will be conducted, especially in a deflationary environment. So first of all, why was unconventional monetary policy implemented? After the financial crisis, there were two problems. First, the transmission channels had broken down and needed to be repaired. In addition, in the aftermath of the euro area, sovereign debt crisis, headline inflation persistently ran below 2%, as you can see in the graph. To deal with this, the policy rate had already been lowered into negative territory. The effective lower bound would have made a further lowering even less effective. As the fear for deflation became larger and the conventional framework did not offer a solution, the implementation of unconventional monetary policy was deemed necessary. So, then I conducted a literature review to see how other authors positioned themselves in the debate about unconventional monetary policy. And the articles on this topic were mainly divided into three groups. First, the ones that discuss the effectiveness of the policy measures. Furthermore, there were articles that went over the challenges arising after the policy measures, and the ones that go more in general about the future of monetary policy. So, the unconventional monetary policy measures followed the 5 transmission channels, similar to the conventional monetary policy. For the sake of time, I will not go over all of them because it would take up too much time and the presentation is only 10 minutes long. But I will discuss the most important effects of unconventional monetary policy. First of all, the asset purchasing programs led to an increase in the size of the ECB's balance sheet, which you can see in the graph. It almost tripled in size in 2021 to 9,000 billion euros. Furthermore, due to the size of the asset purchasing programs, the bond prices went up and the yield curve saw downward pressure, which flattened it. The long-term refinancing operations provided favorable funding costs for companies and governments, preventing them from failing or going bankrupt. In general, the measures have been effective to help ease the financial conditions when standard policy instruments were constrained by the effective lower bound. So, the measures have been effective in supporting the macroeconomic outlook in the euro area, and they impacted real GDP growth and inflation positively. And lastly, investors were in search for higher yield returns, and this caused a flow of capital to emerging market economies, and these international spillover effects specifically led to a decline in country risk premiums, a rise in stock prices, and an appreciation in local currencies. So now we come to the main part of the thesis, and that is how to deal with the two challenges at hand. First of all, the normalization of the situation, and this could be done via three methods. First of all, quantitative tightening. This effectively means selling all securities back to the market which were accumulated through quantitative easing. This has some drawbacks, as it would take up a lot of time because the portfolios are really large, and it puts unnecessary pressure on fiscal budgets. However, it would deal with excess liquidity and reducing the size of the balance sheet. Instead of actively selling, the ECB could also do nothing and let the securities gradually mature over time. This had the same effect as quantitative tightening, but the consequences are spread over a longer time. So this means that market disruptions will be smaller, but on the other hand, the liquidity and balance sheet problems are also solved less quickly. And lastly, there's the option of ECB bonds. This is a perfect option to drain excess liquidity from the banking sector, and it would offer it wouldn't need a reduction of the balance sheet size. That is not necessary anymore for the ECB, as the ECB would offer a highly safe and liquid asset to the market. The ECB bonds also provide the ECB with a solution for the second problem, and that is what policy should be implemented in a similar scenario where the conventional framework does not work in the future. As these ECB bonds give the ECB the opportunity to conduct its future open market operations in its own assets. However, this option is strictly ignored by policymakers, as it would effectively mean that member states' debt would be put together, and generally Western countries do not want to bear the risk of a less disciplined southern country of Greece, of Italy, for example. So there are 4 other options. First of all, the ECB could restore to unconventional monetary policy again. This would run into the same problem of excess liquidity and a larger balance sheet, but it will deal with the situation effectively. However, it would run into legal problems, as it is prohibited by the Treaty on the Functioning of the European Union. Another option is monetary financing of government spending, as this would be really effective to deal with a future downturn. However, this is also prohibited by the Treaty on the Functioning of the European Union, and without an independent central bank, this would run the risk of a less fiscal discipline, and a high inflation rate. Thirdly, there's the option of helicopter money, and this is a form of monetary financing, but it is directly distributed to the people, as if a helicopter would drop money from the sky. And it could be implemented really quickly, making it effective in times of crisis where policymakers have to adapt quickly. On the other hand, it is less effective than straight-up monetary financing, as it would mean that a lot of money would end up on saving accounts of individuals, and it would run into the same problems of less fiscal discipline and possibly higher inflation rates. And lastly, there's the option of deeply negative interest rates. This would work similar to the conventional approach of adjusting interest rates, but to work, the effective lower bound has to be removed, and that's only possible if cash is removed from society, and that's not likely to happen anytime soon. So this would mean that we come to a discussion and a conclusion. General, each policy has its positive and negative effects. ECB bonds would deal effectively with both the issue of normalization and future policy when the conventional framework does not work. However, due to the political resistance, it is not likely that it will be implemented soon. A mix of policies therefore seems like a good solution to normalize the situation. By letting the portfolio of the ECB gradually mature, the ECB leaves room for intervention when needed. As of now, there's a lot of excess liquidity in the banking system, so the ECB can actively sell parts of their portfolio to reduce the liquidity without causing too much market disruptions. Then when the situation is normalized, it can stop with actively reducing their portfolio keeping the market disruptions relatively limited. Ultimately, the monetary policy that would be implemented in the future, when the conventional framework doesn't solve the problem of the crisis, depends on the severity and the origin of the crisis. It was rather ambitious of myself to find one best solution to deal with the future crisis when the conventional framework wouldn't work. However, this thesis laid a foundation for future research about monetary policy and its implications. More research into this topic and the possible scenarios to deal with the problems at hand could help policymakers to make informed and better decisions, such that financial stability can be preserved in the future. Well, this was my presentation. Thank you for listening.